Good afternoon, everyone. My name is James Clark. As mentioned, I'm Head of Tech and Life Sciences at London Stock Exchange. I'm in the primary markets team, and what that means is my job is to work with tech and life science companies who are looking to raise market by coming to the public markets. I also have a background working in venture capital and operational roles in tech companies. I like to think I have a reasonably good experience of raising $1 to IPO and beyond. In the course of my job, I speak with a lot of companies who are looking to raise money, a lot of companies who are wondering what the public markets offer to them, and wondering about whether the process is suitable for them. And a lot of the conversations I have are sort of, I guess you'd say that the knowledge in the market is based not so much on actual wisdom, but on received wisdom. So I'll start with a quote. "A lie can travel halfway around the world before the truth can get its boots on." Now, if you look on the internet, that will probably be attributed to Mark Twain. Problem is, we don't know if he actually said it. No one does. No one knows who originally said it, but people have kind of attributed it to him based on received wisdom. So even a quote about truth and lies comes down to received wisdom and actual untruth. And so the format of this presentation is a number of received wisdoms that I tend to encounter when I'm having conversations with companies about whether they can go public and what the public markets can offer for them. I'm not a unicorn, so why should I IPO? Well, I guess one of the challenges of tech in the last number of years is there's sort of been this assumption that unless you're a unicorn, an IPO is not for you. The public markets aren't there for you. You should raise money privately because there's nothing really on there for the public markets. And a lot of that has been driven by a lot of big news of big companies have gone IPO and places like the NASDAQ who are unicorn size. Now, in London, we do have unicorns. So Alpha Financial Software, probably haven't heard of them, but they IPO'd a couple of months ago. They're valued at over $1 billion. They went up 30% on the first day. So yeah, we do have unicorns here, but actually, we also have businesses like Free Agent. They IPO'd in November. They're worth about 30-odd million or so pounds, $42 million. Since IPO, they're up about 15%. Now, Free Agent came through Robin Klein's Local Globe portfolio. They'd been in his portfolio for about 7 years. The business is doing very well, sort of about 5 to 10 million of revenues a year in pounds. And they saw the public markets as a way for their existing investors to get liquidity and for them to be able to grow into the future. So you don't need to be a unicorn to IPO. You can actually just be a regular business that's growing steadily that needs to find a new set of investors in the public markets whose interests are more aligned with yours at the stage of your growth. We don't have 100 million of AIR, so why IPO? Now, something that's become quite prevalent, especially among B2B companies, especially among SaaS companies, is this wisdom that you need to have 100 million of annual revenues to even consider an IPO. Now, that roughly equates to, surprise, surprise, about $1 billion valuation. The point of it is, though, is that, again, this is based on a particular venue. So this is based on a US listing where if you're not anything, if you're not $1 billion company, you don't break the top 250 tech companies on that market. You're not going to get the kind of awareness you need for a successful IPO. You're not going to have good investors on your books. And yeah, you probably will struggle to IPO. However, Eve Sleep, they were doing about 15 million of annual revenues at the time they came to market. They're down a little bit, but their market cap was about 180 million at the time they IPO'd. It was actually a really good fun IPO. That ceremony, as you can see, was a bit of a party. And what we've done here is what you're seeing is all the photos of these companies as they come to market. LoopUp, London-based company, specialize in web conferencing. They came to market with a market cap of 53 million or so. They're up about 50% since IPO. And again, they didn't have annual revenues of 100 million. They're doing about 15 million a year, and they've grown quite steadily since they've come to market. They're a good growth prospect. They came to market. The market has responded well. Pretty typical of a lot of the IPOs in 2016, I might say. Very SaaS-based, a lot of B2B, good, strong revenue growth, not spectacular, but actually growing steadily into the future. Public markets gave them both the ability to raise new money, to bring in new investors, to find a market that was right for them, and also to give them the capital to grow, like any kind of fundraising would. I need to IPO in the US so I get the best possible valuation. This is one we hear over and over and over again. I can't tell you how many times, every time I speak to somebody, it's all about valuations. And look, valuations are important. Don't get me wrong. But don't assume that you'll get the best valuation by being based in the US. Good companies get good valuations regardless of which venue they choose. If you're a good company, you list on the NASDAQ, you'll get a good IPO valuation. If you're a good company that lists on the Hong Kong Stock Exchange, you'll get a good valuation. And just like that, if you're a good company listing in London, you'll get a good valuation. It has nothing to do with venue. It has to do with quality of the company. Blue Prism. Nobody's heard of Blue Prism. Merseyside company based on machine learning and business process. They IPO'd at about 69 million or so market cap valuation. Look at the growth rate. They're about 660 million today, right? This is from March last year. They are valued far and above anybody in their market at the moment, and they're valued well when they came to market. WorldPay. WorldPay IPO'd in 2015. You've heard a bit of news about them in the last week or so with an acquisition opportunity. They're probably valued a bit more than they were a couple of weeks ago. However, when they came to market, they priced a day after First Data, which was their direct US competitor. Now, these two deals were the two biggest fintech deals of 2015. WorldPay was the biggest deal size, and First Data was the biggest valuation. WorldPay had a far bigger valuation than First Data did on opening day, and they have maintained that valuation ever since. It's not the quality, it's not the exchange, it's not the venue, it's the quality of company that matters. I can't access US investors from London. Again, this is one we hear a lot. It's very straightforward for you as an IPO company to access US investors. You can't get retail investors, you can get all the institutional investors. Approximately 30% of all investors on London's markets are from North America. Jackpot Joy, Canadian company, came to market, listed. Approximately 30% of their book is from the US. We have companies up to 40%. We have, you can basically access investment from all around the world from London. Very, very simple provisions. Purple Bricks, another one. Again, large US investment contingent. It's very easy to raise money from US investors from London markets. There's a company coming up in a minute which I'll talk about separately, but they did a very smart job in terms of raising US investment from the London markets. No one has heard of me, so who'd invest? Now, there's a lot of small companies out there, and our markets have a lot of them. I mean, London, the advantage you have is you can either be a very big company on our main market, or you can be a fast-growing small company on AIM. Cerillion, IPO'd midway through early last year. Market cap of 32 million at IPO, up 68%. They found investment. They've done quite well. Nobody's heard of them here, but I guarantee you they've done well out of this market because their investors have heard of them, and really that's what matters. ECSC. I had the privilege of hosting their market opening ceremony. Really enjoyable experience. This is a company based out of Bradford. The entrepreneur is your classic entrepreneur. 15 years ago, started the business, took out a 50,000 loan on his house. His wife didn't know anything about it until she was signing the paperwork. She didn't mind too much when they IPO'd. They raised about 5 million or so, and they're currently up 48%. So they've done pretty well, and I think the founder did a good job, and his wife is pretty happy about it as well. Nobody's heard of ECSC. Cybersecurity company, they've done very well. Their investors understand them, and the markets have been a good place for them. I can't IPO because I'll need to raise more in the future. Now, this one is actually specific to markets. In the US, if you're trying to raise money after you've already IPO'd, it can be a bit difficult because the market tends to look a bit unfavorably on companies who try and come back and raise money, because the assumption is, why are you trying to sell stock? Is there something wrong with your company? Now, in London, the markets are more pragmatic. They understand that your investors might need to offload some stock. They understand that your investors might have a fund that they need to close, and so they need to find liquidity. So when it comes time for you to raise more money, coming back to the market is pretty straightforward. We've all heard of Just Eat. Just Eat have done extremely well in the markets. They've come back and raised money 7 times since they IPO'd in 2014. They raised about $1.5 billion in all of their fundraisings during that time. There's nothing wrong with coming back to the market to raise. That's the whole point. It is expensive to get on the market to raise money on a public market, but once you're on the market, it becomes the cheapest way to do it. And on the other end of the scale, MySquare, they came back and they did a follow-on a little while ago, raised a couple of £1 million. They've done quite well out of their time on the market, but you can come back to the market to raise money because that's the point of it. Business and markets realize you need that money to help your business grow, and they'll help you do that if the company is doing well. I'll have to do quarterly reporting. This is where we start to get into the specifics of different market regulations. I'm sorry, I don't mean to get into market regulations, but it seems like we have a pretty geeky group in the room, so I'm going to go into a bit more detail. Quarterly reporting is one of the biggest bugbears of any tech company that comes to market, and I can completely understand why. It means your finance department is almost in a perpetual state of delivering the next piece of financial reporting. It puts a huge load on your finance team. It's calculated to be about $1.5 million a year just in regulatory compliance on quarterly reporting alone. In London, you do about half-yearly reporting. So half-yearly reporting means that the cycle is much slower. It means that you're not constantly worrying about what the next quarter is going to look like. It means you actually have time to develop your story on the market. Once you IPO, they estimate you have about two cycles to meet your goals to start fulfilling your story. Now, if your 2 cycles happen over 12 months instead of 6 months, it gives you a lot more time to actually be able to get your story right. So Sophos was one of the companies I was talking about earlier. They deliberately decided to list in London because when they did, they realized their valuation at IPO was about 1.5 billion or so, would put them in the top 90 to 100 tech companies on NASDAQ, but in the top 10 in London. Now, we are a smaller market here, but that does have advantages. It means you can raise money and be in the top, and be in sort of a much bigger fish in a smaller pool. Therefore, you get access to different sorts of investors. You get better quality investors. You get market indexation, and you also get access to benefits of being sort of a bigger company in a smaller market. XL Media again, another company that's benefited from this system where they came from another market to list in the UK because they saw the regulatory structure is actually going to be more suitable for them as a company. And that's legal disclaimer. I don't know why that's there, but they have to put it on there. Now, I've got a bit of time, I think, so if anybody has any questions, please throw them at me. Gentlemen here.
What's the mix of main market versus AIM, or the example you gave us?
So AIM, main market, AIM, main, AIM, main, main. Stop going back. AIM, although probably not for too long. They're sort of tapping on the door of a main market size. AIM, main, yeah, so on and so forth. So basically, look, rule of thumb, if your valuation is up around the 250 million to 500 million market, AIM is your best market. If you're going above 500 million, you probably want to start thinking about a main market because your investor size or the type of investor who's interested in your market is going to sort of have a price range they're into. The reason why London is very different from NASDAQ, as I mentioned, is because the market is very biased towards those big investors, and it can be a struggle to get investment at below $1 billion. Any other questions? Okay. Oh, gentleman here again.
Costs, because I hear that AIM is about £1 million
No.
on the company, including the legal, the auditing, all this thing. What's the rule of thumb?
Rule of thumb is difficult to apply. So firstly, you've got your brokerage fees, which tend to be about 3 to 4% in the UK, 6-7% in the US. UK is much more in line with the rest of the world. The US tends to be more expensive for some bizarre reason. You're then going to have your legal fees or your advisor fees. You're then going to have your listing fees. Listing fees are actually quite small. Your legal fees and your other advisor fees are probably going to be the biggest component at the time of listing, but it's just, unfortunately, that's just the nature of the game. I mean, and obviously it's going to be, depending on the complexity of your legal structure or whatever else, your advisor fees make up a bigger component.
What does the London Stock Exchange feel about these crowdfunding sites that are coming to disrupt your AIM markets and things like that?
Sorry, the question was, how does London Stock Exchange feel about the disruption coming from crowdfunding markets? So I'll look at it a couple of ways. First one, equity crowdfunding, we're a massive fan. So companies like Cedars, companies like Crowdcube, companies like Syndicate Room, we have good relationships with all these companies because essentially from our perspective, if the first money you raise has forced you to be actually quite transparent on the performance of your business, then right from the start, you're actually going to have a culture of transparency. One of the biggest challenges facing a private company that wants to go public is the transformation in culture from being private, fast, high growth, very insular, to being a public, open, transparent company. And that can take, that cultural change can take a lot of changes on the board. It can take internal changes of culture from the organization. If the first money you raise forces you to do that, then it becomes part of the DNA of the organization. So we're very close to these guys because in many ways, they sit a bit earlier than a lot of the stuff that we see on AIM. And in fact, in the last 10 years or so, companies that have come to AIM tend to be about 10 times the size in market cap and 10 times the size of money they raise. So we're looking at a sweet spot of valuations of about 50 to 250 million for AIM raises. You can go lower, you can go higher, but that tends to be the sweet spot. When it comes to things like ICOs, very, very different story. I mean, we're taking a good look at it because we're interested in how the ICO market is starting to play out. We're consulting with regulators because it's a little bit ahead of the news, but our position is those forms of fundraising can be useful in certain cases, and so there should be some sort of allowance to allow that to happen. But we want to see how sort of the market starts to settle down over the next sort of period of time. More questions? Another one? Yep.
London Stock Exchange owns London Clearing House. How does London Clearing House feel about blockchain coming to disrupt the clearing and settlement?
You'll have to ask my colleagues at London Clearing House. I'm afraid it's not where I look at. Anyone else? Okay. Thank you very much, everybody. Have a good afternoon. If you'd like to talk some more, I'll be in the foyer for the next half hour or so. Thank you.